Great. Well, thank you, and welcome to our webinar for today, Amenity Analytics, discussing traditional ESG data sets, next-gen data sets, a wide-ranging conversation. I'm going to give it just a couple more seconds until the attendees number stops climbing as people join this morning. Very much welcome, and we'll get started shortly. Okay, well, I think people will continue to trickle in, but that will certainly work. We'll get started with some introductions, and then, as I said, we have a wide-ranging conversation today for you that I'm sure will be interesting, invigorating, a wide variety of adjectives. But I'll begin with some introductions of our guests this morning. We are lucky to have two of the world's leading ESG experts online to discuss this topic today. Jean Rogers is founder of the Sustainability Accounting Standards Board that we all know today as SASB, currently an advisor to many companies and investors, and a thought leader on this subject. And we're also joined by Bruno Bertocci, who's a managing director of the Sustainable Equity Investors team at UBS Asset Management. Serves in a variety of capacities as well to advance ESG thought leadership. So what we're going to do today is discuss ESG data sets, the history of ESG data sets, the regulatory push we're seeing towards standardization, how that is affecting investors, how investors might want to think about the pros and cons of that landscape, and get into a little bit at the end over how we can leverage artificial intelligence, natural language processing to help create some novel lenses into those traditional concepts. Now, we, in our prep call for this webinar, ran long. So I expect that we might run a little bit long on today's call. The good news, if you have a hard stop at 10:30 Eastern, is that you are always able to pick up the recorded version of this webinar. We'll be putting a link in the chat at the end that you can also reference and following up. So don't worry about reversing back to a particularly interesting point in the conversation. That will be available. We will reserve a little bit of time for questions, but we also like to rope questions in as they occur naturally in the chat. So please feel free to use that question function. You'll see it in the GoToWebinar sidebar, and we will look at and review and answer them as they come in. So with that housekeeping out of the way, I still see a few people are dropping in, and that is perfectly fine. Welcome again to our webinar this morning, and we will jump right into it. So Jean, I was wondering if you could context set for us and the audience. And perhaps, given your experience with frameworks and ESG data sets more generally, can you give a context around what the history of ESG data sets has looked like and sort of where we sit in the present moment?
Sure. Thanks, Bennett. Thanks for the introduction. It's great to be here with you and Bruno talking about one of my favorite topics, ESG data. My own experience now, actually going back a couple of decades, really thinking about and sort of envisioning a system for ESG data that could really serve up data to investors that was focused on materiality and what issues were really important to consider when making investment decisions, is that I think that the whole field really looked to the model of financial accounting standards and, of course, generally accepted, issues. I think there was a desire to be as rigorous and as comprehensive and as systematic as our financial accounting standards when ESG accounting was more nascent. And I think that had both advantages and disadvantages, right? At SASB, we meticulously looked at what issues were likely to be material industry by industry, and looked at how to measure those issues and looked at the best available science, at the time. And that can give you a very, comprehensive view of what issues can emerge and can affect the price of a company. But it is also a slow process. And what has happened in the past couple of decades is that new technologies like social media and unfortunately, no shortage of sustainability issues always sort of coming to the fore. I think in some ways, those standards and frameworks that have been developed weren't designed for that use case where we have new issues emerging all the time. And I think we have to kind of weigh the trade-offs of having hardwired frameworks that have been rigorously developed and had stakeholder involvement and are looking at science with issues that can emerge, for example, the pandemic, right? And what we've been dealing with for the past year and a half, that wasn't envisioned in the SASB standards. They were released in 2018. They didn't really envision or contemplate the idea of which companies were more at risk or more responsive. And so I think there's a place for standards that are rigorous, generally accepted, looking more at risks that are emerging, but also, weigh that with new technologies and what we can do, more in real time.
That makes sense. And I think that an interesting dichotomy that we've seen at Amenity is the value of standards, but then also the fact that if you have lots of investors using the same guidelines, that it's going to be more of a push to find that additional edge or that alpha component. So Bruno, I'll toss it to you. We're seeing a regulatory shift both in the EU with the EU taxonomy. In the United States, the SEC has recently put out several guidelines on things like human capital. Starting at a very high level, do you think that is a step in the right direction? Good or bad? What's your take?
No, sure. I think it is a step in the right direction. I mean, and Gene has heard my shtick before, but I guess I do a read across to what happened to financial data, right? I started in the business when financial data was hard to get, messy, not machine readable. And having any kind of data was actually an informational advantage. I use this example. If you had a physical copy of a small Spanish company's annual report, when you only had a couple hundred copies printed, you actually knew stuff other people didn't know, because they couldn't even get the data. And now financial data has become uniform, but that didn't happen by accident. We had the Financial Accounting Standards Board is an archetype for materiality and standardization for U.S. public companies, and that became the foundation for global standards in the 2003 Norwalk Agreement between FASB and its non-U.S. counterpart. So you're seeing the same sort of thing play out with sustainability data with a real focus on materiality. And I can't underscore how important materiality is, because otherwise you veer off into looking at things that don't really influence the business model or valuation. So yeah, I think this is all a push in the right direction. And that said, it kind of like as you said in the beginning, that emerging standard set of sustainability information kind of completes what I would call the Graham and Dodd mosaic theory of investing, right? To cover companies, for example, that don't have a lot of physical assets, where financial data doesn't help you so much. But investors are always looking for something else. Of course, if you have a hypothesis, if you have a theory about a company that you're trying to answer, you're going to try to find a way to answer that question. So, you know, an extreme example, but you'll get the idea. How about all the people that got satellite pictures to try to figure out how many Teslas were sitting around in the parking lot not delivered, when they were having this whole argument about how many cars Tesla could actually produce and sell, right? People got a hold of some pretty, are there standard satellite pictures? I doubt it, but you know, they were trying to answer a question, and people looked at Google traffic numbers to try to figure out what was going on in China's industrial production. And so anybody who's got a question is going to look for a piece of data to try to answer that question, standard or not standard. Obviously, if we have a reasonably standardized global set of sustainability information, that really makes the markets more transparent, more efficient, and answers a lot of core questions that people might have. But that's not everything, as you point out.
Yeah, no, that's a good point. I think picking up on one aspect of that, the materiality aspect, we see a lot of effort to try and come up with this sort of Pareto conception of what is material based off of an industry or a sector. Jean, you led part of that drive over at SASB. Can you talk a little bit about how you think that fits into today's market?
Yeah, absolutely. And I think, you know, I think materiality is still really key to making sense of this landscape, both in as the data becomes standardized and also in looking for an edge and for new issues and how they become material. And I think that there are a certain set of ESG issues that are sort of enduring and in their materiality, and those are things like climate risk and things like social justice and you know, human capital. These issues are they're long term, and they might manifest different ways, but they are material for a majority of companies and industries. And yet I think that also issues emerge and become material, and that is always going to be the work of analysts and investors to really understand how are those issues emerging, and will they affect, you know, one company, will they affect an entire industry or an entire sector. And this is where you know, standards help us with you know, in my view, sort of the market risk and the things that affect, you know, all of the companies in a particular sector, and really help us understand pricing and how to better price risk. But I think looking at the kinds of issues that are emerging and how issues become material takes looking much more deeply about how a company is run and how stakeholders can affect a company. And that is something that, like, when I first started SASB and, you know, thinking about a framework for materiality, at that time there was this big debate still about, you know, stakeholder versus shareholder, you know, views of materiality, sort of like GRI versus SASB, you know. And what's so interesting is that now I think there's beginning to be more of an understanding of that stakeholders are essential to look at, you know, to understand and to consider if you're a company focused on the long term. And stakeholders also can create financially material conditions for companies in a way that is very powerful through social media and other means that they didn't always have available to them. And so it's a much more dynamic landscape now. Materiality is a much more dynamic concept than I think we even thought when we were getting started with SASB. We thought, oh, we can understand this, we can study this, we can kind of lock this down and have a standard that, you know, is relatively sort of correct, if you will, or sort of identifies the major material issues. But I think the landscape is actually more material than more dynamic than we thought, and that materiality is more of a fluid concept. Certain things endure, but certain things emerge. And that's always going to be the work of a great ESG analyst, is to really keep on top of that. And I think to do that, you need to consider both what is being standardized and new technologies that can help you see what is affecting, sort of one company versus, the entire industry.
Yeah. I mean, speaking of great ESG analysts, we sort of have a UBS representative on the call. Bruno, I'm curious if there are places where you, the team, think critically about where you might want to go beyond a traditional data set or a standard to leverage that expertise.
Sure. Well, we've got a whole team of data scientists that support what we do in active investment. So, their job is really to help us answer questions. If we have a theory about something or a hypothesis that we're trying to answer, then we're going to try to find a piece of information that'll answer the question. And then inside UBS Investment Bank, we've got Evidence Lab, which is also a huge data-driven organization that's built to answer questions. The one thing I wanted to mention, which I think maybe it escapes people because they're so used to it, is that, and this happened on a different call, but there's a misconception, I think, that financial data is kind of all the same, it's all material, and that isn't true at all. First of all, depending on what industry you're looking at, there's specific data that's relevant to that industry that's irrelevant for other industries. For example, think of available seat miles in airlines. That's a very unique metric that's only important if you're running an airline, and it's of course very important if you're trying to compare one airline to another, but has nothing to do with retailing, for example. If you're looking at resource-based companies, you're going to look at how they measure their existing proven reserves, et cetera, et cetera. Has nothing to do with any other industry. But we're used to these accounting metrics that are industry specific and material to the companies within that industry, and they don't apply to other things. It's exactly the same thing with sustainability data. Obviously human capital measures are important, but they're vastly more important if you're running a software company than if you're running a steel company, because your engineers depart for a competitor, your history, right? They're all gone. There's nothing there. And that's kind of my point. I think people are used to looking at financial metrics and specific industry metrics for companies, and they haven't even thought about the fact that you really organize them hierarchically in terms of materiality. Of course, you're interested in return on invested capital of any company you look at. That's an important metric. Are they earning their cost of capital or not? Then there's all this other stuff, which helps answer hypotheses about how efficient the airline is, or how low cost it is, or how it actually generates value for shareholders. And I think as people get more comfortable with sustainability data, they'll have their own mental model. What's important, what's not important. I think the materiality map that SASB developed, it goes a long, long ways towards organizing sustainability data to help people figure that out. But if you've got other questions, you're going to look for other data to support or counter your hypothesis. That's how the business really works.
Yeah, exactly. I mean, smooth transition to sort of our second area of conversation. I think, with your airline example, the perhaps slight difference between financial data and sustainability data is that we have these sort of generally accepted, this is a material financial metric for that sector. We have the indicators like SASB that suggest that clean technology might be more relevant for certain categories. But we are seeing that you can test those different hypotheses and come up with your own conception of materiality or ESG framework that's a little slightly granular or maybe slightly deviates from those traditional frameworks. And Jean, I know in your capacity as an advisor to many companies, that's something that you both discuss with the company and then the investors themselves to generate those hypotheses. So could you maybe share an example or two or talk about what your thought process is when it comes to that exploration?
Yeah, and I think it's really this sort of, having this beginner's mindset and really being curious about the data, and that is what makes a great analyst, no matter what sector you're looking at, or no matter what issue you're looking at. there's sort of a base, set of financial data or ESG data, but you really always have to be curious about what's emerging and how these issues are manifesting and whether they're affecting one company or a whole sector. Just to give an example, SASB has done a great job of really, I think, clarifying the thinking about how ESG issues become material and what that looks like industry by industry. And now it's sort of the job of analysts to continue to kind of interrogate that framework and that data that's emerging, and really understand, are ESG risks idiosyncratic? Do they live with sort of one company? Do they affect the whole sector? Or are they systemic, like climate risk, which is an entirely other way of looking at an issue. So to give an example, opioids, right? An issue that sort of emerged, kind of in pharma, and at first was sort of closely tied to Purdue and a couple of other companies, but then sort of quickly had a material effect on the entire industry. And now we're really just seeing, J&J actually just kind of settling around opioids and agreeing not to sell opioids into the market. And this is an example of how an analyst, would look at this. If it was just Purdue, right, you can diversify away. If that issue is affecting sort of the whole sector, now you're talking about sector allocation strategies and a different way of looking at your portfolio. So the risk mitigation strategies that an analyst would employ are different if it's going to sort of hold tightly to one company or whether it's going to affect the whole sector. And we're starting to look at that now with climate risk and develop hypotheses around whether and how companies are both exposed to risk and how they're managing that risk. And so the types of queries that you might do are really getting at whether a company is making those investments that they need to make for the long term to mitigate that risk.
Yeah. No, I love that topic because I think it speaks to what gets us excited at Amenity Analytics about sort of the power of natural language processing to help investors with some of those questions. Because it is a bit of an onerous manual process to go in and to understand, here is all the press releases, all the SEC filings, all the earnings calls that a company is putting out and where they're speaking about things like investment or a particular sub theme that an investor wants to deep dive in. And one of our products is designed to help answer those questions. But Bruno, you mentioned the evidence lab and other ways to answer those questions. Is what Jean sort of says about how you come up with those and that mindset what you echo?
Yeah, I mean, I think I always remind for people, all of this data, all of this reporting, all of it, financial, non-financial, and otherwise, these are metrics that somehow illuminate the human activity inside the company. That's what you're trying to get at, because a company is really just a social organization that's meant to provide a product or service to the outside world, right? And you're trying to figure out, well, what's actually going on inside the company. And take financial data for an example. Companies could have comparable margins for very, very different reasons. One company makes a product that has a lot of brand equity and commands a lot of pricing power and therefore has strong margins, and another company could have actually underinvested in R&D and in property, plant, and equipment, and temporarily have the same, cosmetically the same margins, but they're very, very different companies. If you don't ask the question, what's going on inside the company, you're not going to get an answer. In every case, you have to have a well-crafted question so that you can gather the relevant data to answer the question. The thing about natural language processing is, if you're not careful, you will produce a lot of nonsense that you don't know what to do with. And the same thing goes for AI. I've had quants deliver to me a model that they produced using a gigantic box of data, and they go, well, here's the fit. And I'm going, well, do you know? Do you understand? Do you have a theory about why this model works? Well, I have no idea. I just pushed the button and it came out. I don't know what to do with that. That's just a backward looking fit. You have to have some inherent logic to the result. And we know the data isn't perfect in many cases. So if you have a well-crafted hypothesis, you can gauge whether the data is answering your question or not. But otherwise, you can just fall down a data rabbit hole, and then you don't really know any more than you did before you started. It's often useful to say, well, to answer this particular question, what would be the absolutely perfect piece of information that would answer the question? And if you can write that down, you can try to approximate it. You're not going to get that perfect information, but having a mental model of what the answer actually is before you start, that often illuminates the process a lot, and it prevents people from wandering off into some kind of data labyrinth, which is easy.
Yeah, it can happen readily. Well, speaking of questions, I just once again encourage any attendee to put your own question in the chat. We'll weave them into the conversation.
And while we're doing that, Bennett, I just wanted to make one other comment, about hypotheses, and I really think that's the frontier of ESG. Investing is really crafting those great hypotheses and being able to query what are now very large data sets and voluminous information about ESG, and it's really being able to interpret that with hypotheses. And Bennett, when we first met, a couple of years ago now, I was working on a project to really understand which companies were truly authentic in terms of their climate commitments and their, the commitments that we're making around net zero carbon. And again, and it was sort of reminded me back of the early days of SASB when we were developing this framework. We didn't know what we were going to find. We didn't know what issues were going to emerge as being material. And so we didn't know when we first started what we were going to find around were companies really talking about adaptation and mitigation, and were they talking about it consistently, or were they making those investments that would lead you to believe that they are actually going to be successful in climate mitigation? And so we together developed a taxonomy and went into those earnings call transcripts and the filings, and looked at the sort of excerpts. And again, this is investor communications, right? Like not sustainability reports, but like sort of the real deal about where you would expect companies to actually talk about investments or capital expenditures. And what we found was that, yeah, there was a drumbeat, certain companies talking about investments they were making in adaptation, essentially exposure to weather-related events and sort of shoring up their own facilities or their supply chain, and also a drumbeat of companies talking about greenhouse gas mitigation. But right around Climate Week, we saw this huge spike of companies making commitments and talking about net zero and carbon neutral. And you could actually distinguish the ones that were just making statements during something like Climate Week versus the ones that were really consistently talking about this on their earnings calls, in their investor communications, and talking about capital expenditures, which of course is what you actually need to decarbonize, the hard industries that really do need to be decarbonized, like mining and so forth. So there is a pattern recognition that you can do with natural language processing that I think is really telling about the companies that are authentically making those investments versus the ones that are not.
Yeah, and we actually just got a question in the chat. It's like, how can you tell when the companies are lying? So that brings up sort of the question of greenwashing, and I think it's very valid. You alluded to one difference there, which is that you have sort of a higher standard in financial reporting. So in your earnings calls, in your SEC filings, you can't necessarily have the same puffery. But for example, with that climate week, when we saw that spike of company commitments, we've recently seen a suite of products come out across many different data providers to track those commitments over time. MSCI, just for example, released a really interesting one that will track the commitment and then look at the actual carbon numbers. But that's still a little bit sort of backwards looking. So I think what we did, looking at where the companies are investing, if they keep putting out commitments that relate to that original press bump, is a great way for an analyst to sort of stay smart beyond that big PR push that a company may make.
Well, one thing I wanted to say is management's lied about their financial results, or what's going on with their financial results. And there are plenty of historical examples of it. And I guess I would say we actually hired a team. This will sound a little creepy, but it actually works. We hired a team of CIA interrogators to teach us, what to look at when you ask management questions. And most of the stuff that people think matters, twitchiness or whatever, and that's all nonsense. That doesn't work. If there are other tells that kind of help you figure out if management is telling you something that isn't true. With Reg FD, they're often highly scripted, so you're really asking whether the scripted statements are true or false. Pro tip though, one of the things that the interrogators told us is ask very broad, open-ended questions. If you ask somebody, or what's going to happen with your capital expenditure next quarter, it's pretty easy to script a question, an answer to that. If you ask really, really open-ended questions like, what do you think the company will look like 2 or 3 years down the road? That's a very difficult question to answer with a script that isn't true. And you can keep asking those open-ended questions to different people in management and see if they're congruent. That's a tip. But I think it's just, I think the vast majority of managements are trying to tell you something that makes their company show in the best possible light without specifically trying to deceive you, but they're trying to sell you a car, right? It's shiny, it's got great bumpers and comfortable seats, and it gets great mileage, just like a car salesman. And I think that's just the way the business works, and it's up to a discerning person to figure out, is that really what I'm looking at? What's underneath the car, and is there a hole in the trunk, and that sort of thing. But you have to develop a hypothesis. It all goes back to what Gene's talking about. You got to have a well-crafted question. You're not going to get to the answer if you don't. If you just go in there and just bounce around like you're wandering around in a dark room full of furniture, you're just going to bark your shins. You're not going to know anything at the end of it.
Yeah, absolutely.
And Bruno, you're also getting at the difference between performance of a company, now, or even, most performance data is a year out of date already, versus the priorities of a company, which actually tell you where it is going. And that's really a difference. I like to call it the difference between sort of first order and second order data or information. And most of the ESG data that's out there now, as well as most financial, is sort of first order data. It's like performance on a certain metric, like what are your carbon emissions, or what does your diversity numbers look like? But what's more telling about the trajectory is this second order information, like is carbon a priority for your company? Is diversity a priority? And that's a whole different lens on the information, on the questions that you would ask and the information that you would look for that would tell you where a company is really going on these intractable issues. And, this is a classic, actually, way of analyzing the financial trajectory of a company and hasn't yet, I think, been applied or, in the ESG space. But, I always think about it actually is Howard Marks who wrote the book called The Most Important Thing Illuminated. And in that book talked about looking at applying second level thinking, essentially skating where the puck is going, not where it's been. And I think that this is now the challenge for ESG data is yes, you need first order data, that's like velocity, but you also need to understand acceleration if you want to know how fast a car is getting from point A to point B. And the acceleration is the equivalent of understanding what are those priorities, right? Asking those open-ended questions and understanding what investments the company is making and how important this is to the company.
Yeah, having those priors. Sorry, Bruno.
I was just going to say, look, I always tell when we have a new person joining the team, I always explain to them that most of the stuff that you can gather, all the data that you have, financial and otherwise, paints a picture of a company that reaches a certain conclusion. It's a low margin, it's a high margin company, it's got good management, it's got bad management, it's got a great board, a bad board, makes a great product, not a great product, and all of this affects the valuation. This is all known. And the market's quite efficient at gathering up all this historical information and painting this picture. And your job is to kind of stand back from all of this and say, is this thing that the market believes about the company true or false? And I'll digress for 1 second. I always give people that join the team a particular essay to read. It's an essay that actually I got when I was in college. It's an essay by an English historian, H.R. Trevor Roper. He was actually an MI5 operative, a very talented spy at one point. But he wrote this super interesting article titled The Elizabethan Witch Craze of the 16th and 17th Century. And the purpose of reading that is that people in the 16th and 17th century believed in witches and had a completely internally plausible, consistent, logical approach for finding them, testing them, detecting them, and doing away with them. If you stand back from that, you go, none of this makes any sense whatsoever. But if you're living in that world and you believe everything that they believe, it's completely logical and consistent. But the hard part is getting outside of that world and coming up with a different conclusion, being able to test it. And obviously, during the witch craze, you couldn't test it. People just believed it and they acted on it and they did things about it. And the point that I'm trying to make is, yeah, I get it. It's an extreme example, but I'm just trying to give people a way to think about a completely wrong but internally logical set of beliefs that people adopt about something that can't be questioned. And your job is to actually be able to put that at arm's length and question it, and then to gather information that will poke a hole in the theory. And if you can't do that, you're still inside the bubble.
Yeah, absolutely. A bit of an amenity plug on your CIA and MI5 note. We talked to the same, well, maybe not the same, but similar personas, and built out a couple products. One we call Deception, looks at those language tics and tactics that executives might use to indicate that they're not being entirely truthful. Mainly shows up in the Q&A and not the prepared remarks of those earnings calls.
Exactly. That's where they can't script it quite as well.
They've been getting better, so we've had to do some retraining to sort of keep up with them. But really interesting data set, because you're not going to listen on the call and pick that up. You sort of have to check that, or be specifically trained. One client said they had a psychologist in the room for every management meeting that would just be quiet but would listen in. And your other point on sort of checking that mindset, I think that's what I've gotten out of this conversation, that you have those traditional data sets. They may be telling you one thing, but you sort of need to pop up those flags and say, is this consistent with my expectations or my hypothesis? And we just launched a cool product called Greenwashing that sort of helps get at the difference between company perception the statements that they're making and your external news, one of those tools that you can use to check that hypothesis. But I'd like to wrap up with one more question for Jean and Bruno. I know we're already a little bit over, but I'd like to flip the frame and think about this more from a societal company standpoint. How can data serve an end outside of investment? So particularly, how do you think these traditional ESG data sets and then some of the hypotheses that we've been discussing, do you think that they will help companies improve their energy strategy or point them in the correct direction? Or is there something that we still need to do to get that outcome?
Well, just really quickly, I hear a lot of companies now, because ratings are so important and they're based on these ESG data sets and they drive capital allocation to funds. I hear a lot of companies now sort of asking the question, essentially saying, how can I game the ratings? And, I think it's actually a good thing that the ratings don't match because it's harder to game. But I think companies have to focus on their authentic stories, their authentic core competency, and be driving performance on what is material, and setting those priorities that make sense for the company and investing against it, because the low-hanging fruit is all gone. We're now at a point where these are intractable, long-term, tough issues that take investment over the long-term. Climate risk and social justice being, two of the biggest issues. And so authenticity is key. And I think that companies need to think about their own communications and whether they are authentically communicating their priorities or whether they're just communicating to maybe game a rating, which at the end of the day, isn't really serving anybody.
Yep. Bruno, any last words on that?
Yeah, so it's interesting what Jean said, and it squares with a sell-side report that I just read from Sanford Bernstein. It basically says the ESG ratings matter some, but investors are becoming much more adept at figuring out what's real and, if you like, authentic about the business model, and that drives valuation over the long run. A bunch of rhetoric about how your company is diverse, but you look at the board and they're all golfing buddies of the chairman. That's just bullshit. It. You can figure that out in 10 minutes. The information's there. So, I think the market's just getting smarter about assessing this information and reaching better conclusions about it. And of course, if the company is doing real things with their business model and their management structure and their products and services and the rest of it, then the market's going to figure that out and value accordingly.
Yep, that's the golden ticket. Perfect. Well, Jean, Bruno, your insight, as expected, as always, was really appreciated. I have a feeling this is going to be one of the more paused and played back webinars that we've done. On that note, attendees, this will be available, for you to review or pass along to any colleagues. And we really appreciate you joining us today. There's also the Cliff Notes version of some of what we discussed in an article that Jean wrote, available on our website called Sail Your Own Race, and I definitely would encourage you to read through that as well. Well, we will leave it there for today. Conversation always continues. Please feel free to reach out to Amenity if you want to continue that conversation, and look forward to engaging with you in the future. So thank you, everyone.
Thanks.
Thanks,
Bye now.
Bye, Bruno.
See ya.